Welcome back. My name's Chris Gosselin from Australian Fund Managers. Today we're talking to Rob Gregory from Glenmore Australian Equities Fund. Rob's fund has nearly 5 years, coming up to 5 years track record, over which time he's produced 25% per annum. And in 2021, he's returned 39%. That's a pretty impressive performance. Rob, tell us how you did it and what you saw in 2021.
Yeah, thanks, Chris. Yeah, look, 2021 was a pleasing year for the fund. The 39% was generated from a reasonably broad-based group of stocks and sectors. So there was a number of stocks. I guess the key theme from the stocks that did well for the fund were quality businesses that delivered strong earnings across that 12-month, and they saw they saw their stock prices re-rate accordingly. So yeah, I mean, some of the top performers were in the financial services space. MA Financial, which was previously known as Moelis Australia, that did very well. Pinnacle, which is a funds management distribution company, also did very well. They were two companies that delivered very strong earnings across the period. In the resources space, Mineral Resources continued to do very well. That's a name that would be well known to a lot of viewers. It's been a very well run company for a long period of time. And one company that's a much smaller company that's just starting to emerge as a coking coal producer is Bowen Coking Coal, which did very well for the fund. And that's basically not in production just yet, but has a number of assets that acquired a particularly strategic asset off New Hope in August last year, being the coal wash plant in Queensland. So that's a company that I think did very well in 2021 and continue to do so. And then in addition to some of those stocks, there was also 5 to 10 names across a range of sectors that performed very well. ARB, Dicker Data, Livestock Communities, and just to name a few that did well. So, but yeah, look, certainly the backdrop was favourable. I think the All Ords accumulated did 18% for the year. So certainly a favourable year for equities, and I probably wouldn't expect that sort of rate of appreciation in 2022. But yeah, no, look, it was a pleasant year.
So just going through some of the names you've mentioned there, it's pretty clear that you don't invest in a specific sector. So you're not a specific small cap company or large company investor. You're across all caps, across the whole market where you see value.
Yeah, that's right. Yeah, look, I mean, I think it's one of the advantages of the mandate we have at Glenmore is that we can invest in any market cap stock. We're really the first thing we're looking for at a company is that company quality, whether it's a product or a service that has particular merit or use for its customer base. So we're looking for that quality of company, and then after that you drill down into the valuation. But the consistent theme across the life of the fund in terms of stocks that have performed well are ones that have been on the cusp of significant earnings growth that often at that initial point of our investment, that earnings growth isn't really factored into the stock price and valuation. So really looking to partner with good quality businesses run by high quality management teams that can grow earnings and valuation over a multi-year period.
Rob, just looking forward, I mean, we've seen over the past 3 or 4 months, in fact, you could say over the past year or two, the constant threat of inflation. Now that's been accelerating more recently, and we saw very high inflation figures out of the US overnight. We've constantly been talking about a reduction in central bank support. We saw Jerome Powell again overnight trying to talk down that fear. To what extent do you see, looking forward into your crystal ball, what's going to happen in 2022?
Yeah, look, in terms of monetary policy, my expectation would be similar to most participants in the market, where I think we'll see rate rises from the US Central Bank at some point over the next few years, the next 12 months, probably multiple rate rises. I think there's just already this general rhetoric from most of the central banks that we've got inflation rising quite significantly. So and on top of that, we've got a recovering global economy. So we need to expect interest rate policy will rise over the coming 12, 18 months period. So, I think I would be expecting that to continue. In terms of what impact that has on the ASX, I think you can expect to see particular valuations of highly priced growth stocks. I think the valuations of them, will compress over the next 12 months. We've already started to see that over the last 2, 3, 4 months for a lot of stocks. But I think that you can expect that to continue. The other sort of earnings impact, I think, on a company-specific level is a number of companies will face rising costs, whether that be labour or raw materials or just logistics costs. And I think there are going to be some situations where there's an earnings impact, even if it's a short-term earnings impact. I think you will see some earnings impacts on stocks, on the ASX over the next few reporting periods.
And how do you go about adjusting your stock selection or portfolio construction in that environment? Do you reduce your overall weighting to the market either through increasing cash, or what's your approach to that?
Yeah, look, I mean, it's not, it wouldn't change overly based on macro events. It's very much a bottom-up stock picking fund. So we're looking for a business that we believe can grow over a period of 2, 3, 4 years. So I wouldn't say it has a dramatic effect on portfolio composition. The main driver of changes to portfolio composition is simply valuations of individual stocks reaching what we believe is our fair value of the company. And also, in addition, there might be from time to time other stocks in the portfolio that we believe offer better expected returns. So that can be a catalyst to reduce the position in one stock and put more money into another stock. But look, the macro situation absolutely has to be taken into account, particularly with rising inflation. And I think the key thing to focus on for the next 6 to 12 months is just that the company's ability to pass on rising costs. That's going to be a huge issue for the market for the next 12 months.
Rob, do you tend to cut companies out or positions out of the portfolio fairly quickly when you see situations change, or are you a fairly patient long-term investor?
Look, that's a case-by-case situation, I think, Chris. There are definitely times where I'll be patient, particularly if it's a company and a management team that we have a lot of confidence in or have known for a long time, or we believe that, it has a very robust business model. But certainly, look, there are times when stocks are exited quite quickly, particularly if we believe the earnings outlook is deteriorating, or the valuation is particularly expensive relative to its earnings growth. So, look, it's a case-by-case situation there.
Okay. Rob, just generally, do you see the local market being overpriced as a whole? I mean, you're obviously very good at buying underpriced assets or companies that are just, as you said, just about to start on a growth cycle and have been undervalued or haven't been fully valued by the market. But do you see the market as a whole being overvalued, as many people are saying?
Look, I probably wouldn't say the overall market's overvalued. Look, it's a lot. It's nowhere near as cheap as it was 12, 18 months ago. But my main focus is on the stocks in the actual portfolio at Glenmore. I still think a number of them are very attractively priced on a 1, 2, 3 year time frame in terms of looking at if they deliver on what I think they can deliver. I think the valuation will still rise quite significantly. Overall, it's not something I spend a lot of time looking at the overall market. But look, it's certainly I think certainly certain parts of the market have been quite expensively priced, and I think, to be honest, we've seen some of those stocks and sectors derate the last few months. And I think that's quite a healthy thing for the market, because I think some of those, particularly more speculative stocks and companies, I think they'd run too hard.
So there's always that opportunity for someone such as yourself at Glenmore to be able to, out of over 2,000 stocks on the ASX, to find pockets of really good value.
Yeah, I think so. Yeah, look, I mean, I've worked in the markets for a long time now, and you absolutely. And reality is, you have periods where the stock market is incredibly cheap, reasonably cheap, fairly valued, perhaps a little bit expensive, and so there's lots of different phases of the stock market. But as a general comment, it's a fantastic vehicle to try to create wealth, and so the real focus is really just continue to try to identify those businesses that can grow earnings over a significant period of time. So, look, I still remain very confident.
That's terrific to hear. I'm glad you're confident. There's other people who are a bit nervous about these things. I think what you've done in the past has obviously paid off, and we look forward to seeing more of it in the future. Well done.
Thanks, Chris.